Hey guys, welcome back to the channel. In this video, I'm going to be talking about a question I always see come up quite a bit, and that is, should you invest in ETFs, index funds, or should you go with individual stocks? All right, so if you guys have been following me for a little bit, you guys know that in my previous videos, I usually show kind of a live, portfolio, view. I give you guys my entire portfolio, what I'm invested in, right? So that's primarily between REITs, a couple BDCs, but I also have a huge portfolio in an index fund, which is the S&P 500, right? So I just want to give you guys my experience, my own insights, and hopefully share a little bit of advice to help you decide what you want to do. All right. So the first thing we want to think about, or the first thing I think about when people ask me, what should I do? Should I invest into individual stocks or should I invest into ETFs and index funds? The first thing that comes to my mind is diversification, right? In my last video, I talked about, if you are a brand new investor and you're just getting started, it may not make a whole lot of sense to be putting your money into like 10 or 5 or 10 or 15 different positions, right? Because it's going to be hard to really move that needle, right? It's really going to be hard to build that wealth, right? Instead, you should get laser focused on a single product, on a single stock ETF, right? Which would be, something similar to like an S&P 500 index. But if you're really betting on tech to do really well in the next coming decade or for the next 3 decades or whatever, then you can go with something like VGT, which is Vanguard's information tech ETF, or you can go with the Invesco QQQ, which tracks the NASDAQ 100. You can go with that ETF, right? So you're getting broad diversification. Whereas if you're investing into a single stock, let's say you're gonna invest in Apple, right? Let's say you're investing in Apple, Google, Meta, Nvidia, things like that, right? Again, if you're putting like $10 here, $15 there, $20 there, it just gets really hard to move the needle. And then we run into this thing about price point entry, right? When is a good time to buy these stocks? Is it at a good price, or should I wait? When you invest into ETFs or index funds, it really eliminates all of that guesswork. You just keep dollar cost averaging. And if that ETF has a massive dip, like let's say it dips 5, 10, or 15%, that presents a buying opportunity, guys. All right. That presents a huge buying opportunity, right? Because when you're investing into an index fund, S&P 500, for example, or QQQ or VGT or FTech, you're investing into, 500 companies or 200 companies or 100 companies, right? Your money's being spread out all through a single product versus you having to buy all 100 of those companies. Do you see the value in that, right? It's as passive as you can possibly get. It's a set it and forget it kind of strategy. It works the best. That is what I recommend to new investors, especially those who are trying to like build wealth and get started in their early days. Now, when you get that portfolio to a sizable, position, let's talk 100K, right? That might be a little scary for some to imagine, but let's pretend you get it to 100K, right? Then you could start thinking about opening up smaller positions. Or maybe you get it to $10,000 or $20,000. Then you can start thinking about opening all these tiny little positions all over the place, right? That's called a core satellite approach. So the other thing that comes to mind, whether you want to invest in individual stocks or if you should just choose, an ETF, that tracks either an index fund or maybe it's a thematic ETF, that something like a tech sector AI type of ETF. The other thing that really comes to mind is how much time do you have on your hands? Because if you're going to be investing in individual stocks, you got to do the research. All right. It's easy to just go on Facebook, on X or Twitter, or look on YouTube and find, the latest fads, the latest trends, the latest momentum stocks and all that stuff, right? It's easy to go tech, right? It's easy to choose tech because they're fast growing. Their return profiles are very, sexy. But for every other stock, it might need a little more due diligence, and you should absolutely do due diligence on anything you invest your money in. Okay. There's just too many dang YouTubers out there who, peddle a lot of nonsense. They tell you to buy or that they're buying all these, crazy stocks at these absurd prices. and going heavy in, but they don't really show you the trades, right? They don't ever show you the buy, the receipt, or anything like that. They just say, nope, I went out and bought a bunch of these shares of this stock. I think it's going to do really well. And that's really all they tell you. They don't tell you anything else, right? Because they're getting their information from probably someone else who also didn't do the research. So how much time do you have on your hands? That's a question you need to answer for yourself. Because if you're going to be investing in individual stocks, it requires a little more due diligence, right? That's what we call it, or research, right? You're going to want to look at the financials. You're going to want to look at the investor presentation. You're going to want to look at, how it's been performing, not just stock price, but the fundamentals, right? You're going to want to look at all of that stuff. And that could be really time consuming. And trying to juggle that with a full-time job, wherever you're working, it can be a little too much. Now, I invest in both individual stocks, primarily REITs and BDCs, as well as an ETF, right? ETF that tracks the S&P 500, right? Because that's the easy one. That's a give me. It's like you might as well just put money in there. To be perfectly transparent, my 401k is all in on an S&P 500 index. But for my individual portfolio, like for those of you who do know, I'm big into real estate. I really love the asset class. I love everything that real estate has. I know the compounding returns, the historical performance of REITs. I also know real estate, right? I know real estate very well. I know the power it has to compound wealth, right? So I went with REITs. I've made a couple of my own mistakes, right? And I'm learning on the backs of giants, right? I usually go to Seeking Alpha to kind of read through analysts, bears and bulls. If you don't know what those are, basically a bear is someone who thinks the stock price is going to go down or the company is going to go down, whereas a bull, has a bull thesis. They think the company is going to do well. And I read through these analysts, and just kind of come to my own conclusion, right? If there's one stock where every analyst is saying it's a good time to buy, maybe it makes sense, right? But more so and more times than not, you're going to come across a lot of articles that say, no, this stock is bad and this stock is good. And the answer is somewhere in the middle. Okay. So again, how much time do you have on your hands? See, I worked as an IT for a long time, right? I worked behind a desk. So I was always reading articles on Seeking Alpha. And then, I went down the rabbit hole and just started listing out the REITs and the stocks and the BDCs I was interested in, and just started, really like learning about them, learning the fundamentals, and then, built out a list of stocks I was interested in, and then went out and built a portfolio. But I didn't stop there. I went even more further and decided to copy basically an ETF, because on M1 Finance, you can kind of do that, right? So I decided to copy an ETF, and I chose to go with a market cap weighted approach to my portfolio. Now, some would say that's ridiculous and dumb. Others would think that's probably smart. But again, the answer is somewhere in the middle. Anyways, moving on. What is your risk tolerance? That's a huge part of all of this, whether you should go with ETFs, index funds, or individual stocks. All right. So when we talk about risk tolerance, we're talking about how much money can you lose, right? Ultimately, that's what it is. Now, if you're someone with a sub $10,000 net worth, that's all the money in your bank accounts, that's all the money in your investments, then your risk tolerance is probably going to be high if you're going into a single stock, right? And hoping it does well, right? Your risk goes up substantially, because you could, let's say you drop $5,000 into a single stock and the rest of your $5,000 is in an ETF. Well, your risk is pretty high. It's really high relatively speaking. Okay. You also have to think about, when we're talking about risk tolerance, is kind of like your time horizon, right? Time horizon meaning like, when do you expect to retire? So whenever, people ask me like, oh, should I do this or that? One of the questions that come to my mind, and I'm not a financial advisor by any means, but one of my questions is, when do you realistically hope to retire, or how old are you? Because that will help you kind of shape your decision making. That will help you come to a conclusion. If you're young, I'm 34, right? So if, let's say you're sub 35, right? You still have about 30 years, maybe 25 years of work left. That's still a lot of time to compound, right? That's still a huge amount of time to compound. So from 18 to 35, you're in your wealth building stage, right? You're in your you want to grow your wealth as fast as possible. So you may be able to take on a lot more risk, right? Because you still have a long time to, continue to make money, to make income. You can weather those mistakes that you might make, right? Especially if you go with the individual stock. Now, if you're going with an ETF, it kind of alleviates a lot of that risk. But if you're later on in life, and I'm gonna just throw a number out there, but let's say you're in your 50s, 55, you're approaching retirement, you're hitting that 60-year-old, right? I don't know how you feel about working a job at age 60. I know I certainly wouldn't want to work a job, but when you start getting into those later phases of life, you're in your wealth preservation stage, right? You've accumulated a lot of wealth in the first half of your life, and now in the second half, or hopefully the final third half of your life, you want to keep that money making you money without taking obscene amounts of risk, right? So that is kind of the way I would look at it. Whenever you're deciding, should you go with individual stocks or should you go with ETFs or index funds? I know index funds and ETFs are really not all that sexy, especially when you're comparing profile or portfolios with people and you're like, oh, look, I invested in Nvidia and this and that. And oh, I got in early and blah, 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 blah. Yeah. But while that is sexy, having an ETF never go to zero or lose 90% of its value is also pretty sexy. All right. I'm just saying there's plenty of stocks out there that have lost more than 90 to 95% of its value. If you guys remember the EV craze back in 2020 up until like 2021, 2022, there are some very famous names out there. A lot of investors were hopping on it because of Twitter and because of YouTube. One of the famous ones that I can recollect is Workhorse. WKHS was the ticker. Another one was NIO, NIO. If you look up those tickers, you will see that it spiked ridiculously high because Tesla was going up and everyone was buying into Tesla. And then they said it's too expensive. Let's look for the smaller companies, the up and coming. Let's get in early. And a lot of YouTubers, oh God, a lot of YouTubers were pushing this stuff. A lot of Twitter people were pushing this stuff. And then the share price crashed and I don't think it's ever recovered. So again, just word to the wise, always do your research, understand risk. Risk is how much money you're willing to lose if you take this bet, right? Another thing I like to bring up whenever people are talking about buying individual stocks or ETFs is what are your actual financial goals, right? People get enamored with, passive income and, generational wealth and becoming a millionaire and all that other stuff out there, which is all great. It's all good. But does it align with your financial goals, right? If you're trying to grow your net worth up to a certain dollar value, should you be investing in dividend stocks? Just think about that. Dividend stocks, they don't really grow as fast as, some of these other types of companies or some of these other type of high growth ETFs or large value ETFs. So does it really make sense? Again, that's for you to answer. That's for the person who's trying to decide individual stocks or ETFs, what makes sense for them, right? It has to make sense for you and your financial goals. I'm not saying it has to be this way forever or this way for the next 20 or 30 years. I'm saying that depending on your goals, and that's why in my last video, I said, my success, my financial success skyrocketed when I learned how to do goal setting properly. Because I always put dollar amounts of what I wanted to achieve. And I wanted to achieve $10,000 in passive income a year, right? That was just a goal, right? It's changed since, and I reached it. I reached $10,000 in passive income. And then I wanted to change it. And of course, my strategies followed suit, right? Dividend investing is a piece of that. Investing into real estate is a piece of that. So I'm not really into the super high growth, super sexy, tech sector or whatever else. I don't even invest in gold. Like I'm not saying gold's a bad investment or not. I'm just saying I don't invest in it. You can invest in gold in the ETF version or actually own physical gold. I never got into it. So my thing is just it has to make sense for you and your goals. All right. So if you're going to be deciding on whether you want to invest in individual stocks or an ETF product, make sure it matches with your financial goals. All right. And if you do decide to go with an ETF, all right, this is kind of where things can get a little messy. Go with an ETF that has a low expense ratio. I have plenty of videos on this channel that talk about how to research an ETF and how to look at what the expense ratios are using Seeking Alpha, right? You can even use Google and go to the vendor's website, right? Like if it's a Vanguard fund, go to Vanguard and look up that ticker, that ETF ticker, and you'll see how much they charge for an expense ratio. But there's so many ETFs out there and investors out there, right, who will invest in these ETF products without actually knowing how much that expense ratio is going to eat into their total return, right? Their total return over many, many years. If you owned a Vanguard ETF, ticker VOO, which is an S&P 500 index fund, and if you own that over like 30 or 40 years or something like that, you'd only be paying, $15,000 to $20,000 in fees, right? Ridiculously low. But if you're investing, and the expense ratio is like 0.03%, if I remember correctly, but if you're investing in something with a 0.5% expense ratio, or even a 1% or a 2% expense ratio, that could be the difference of, $100,000 to $200,000 in fees that you would pay just owning that ETF product, all right, over the life of the fund. So again, there's plenty of calculators on Google that you can look up and you can kind of play around with, but always go for low expense ratio ETFs. I would recommend anything under 0.05%. All right, when you start getting into that 0.1%, range, that's when you got to kind of really consider that. And again, I used to own ETFs, especially covered call ETFs that had 0.5% expense ratios, right? They're approaching the 50 and 60s. So again, I ended up selling out of them. Didn't make sense for me. And I would highly advise you guys, if you're going to be investing in any ETF product, that you make sure you understand that expense ratio. All right. I hope you guys are finding a lot of value in what I'm talking about here. Again, we're trying a different format because I just want to try a different format. So if you're getting some value from this, please let me know down below in the comments. Please hit that like, hit that subscribe. All right, let's keep going. So another thing I'm going to bring up, especially when people are talking about investing into single stocks or ETFs, is how do you want to spend your time? Because that will dictate a lot of what you decide. And again, this isn't forever, but this is in the beginning stages. If you've never invested in the stock market, go with an ETF. Go with a simple ETF, low cost, tracks the S&P 500. If you're a tech type of person, you want to invest in tech, go with something like VGT, FTEC, QQQ. Of course, I'm not giving you financial advice. That's just some ideas that you can look into. If you're going to go with individual stocks, right? There's a book by Peter Lynch called I think it's One Up on Wall Street. And he talks about investing in stocks isn't really all that complicated, right? We as humans make it more complicated than it should be, right? But really investing in stocks is not as complicated as one might think. There's 100 different ways to analyze stocks, right? 100 different models, 100 different methods, 100 different strategies, 100 different this and that, right? But one thing that he brought up in the book that I really, really liked was just buying what you know, right? He was talking about his wife was like really all about this clothing line, right? She was all about this clothing line. She was crazy about it. And he noticed that there was long lines for this clothing product. So he searched to see if they had a stock, and they did. And then, he looked a little more deeper into the company. He liked the financials. He liked that they were increasing their revenue year over year, et cetera, et cetera. And then he ended up buying the stock, and it turned out to be what he calls a 10 bagger, right? It was a great investment, right? But he noticed that. He just looked at that and he sees his wife buying these clothes, and it has a huge fan base. What other company has a massive following and a fan base? Something like Apple, right? Something like Apple. If you drink Coca-Cola every single day, which I hope you don't, Maybe Coca-Cola might be a good stock, right? Warren Buffett owns that. Microsoft. I'm sure if you work in an office, you're using Microsoft products. Maybe that might be a good stock to own. I don't know. If you're using Facebook every single day, Meta, right? Meta might be a good stock to have. So again, you can buy what you know, right? Louis Vuitton has a stock. Nike has a stock. Some car makers have stocks. BMW has a stock. Mercedes-Benz has a stock, right? I'm not saying go buy those again. I'm just saying, investing is not as complicated as one might think, but there is kind of some beauty in the ease of investing, right? And if you're buying companies that like, and trust, then the rest will take care of itself for the most part. All right. But of course, you should always do your due diligence. All right. Remember what I mentioned earlier about the core satellite approach? If you want to invest in ETFs as well as single individual stocks, you can follow what's known as a core satellite approach. Basically, if you look at the core satellite approach, the core of your portfolio is going to be an ETF of some sort. Maybe an S&P 500 index. Maybe it's some type of tech-heavy ETF like QQQ, which tracks the NASDAQ 100, right? You can go with that. And then you can have a bunch of these smaller little positions, right? Individual stocks. Maybe you have some NVIDIA, maybe you get hyped about AMD, so you want to buy some AMD. Maybe this new, I don't know, crypto, ETF comes out and you want to get some exposure to that. So you go and, put a little bit of money in there, right? But the bulk of your wealth is in the ETF, right? So if one or two of the three of these little positions fall or drop in 90% in value, it's not going to destroy your wealth. And that is the key point of the core satellite approach. If one of these tiny little positions fails, your whole portfolio, your net worth, your wealth is not going to just, go out the window. All right. So that is the biggest point about that. When you're investing into ETFs, when you're investing into individual stocks, a lot of times people ask, is this the right time to invest? I hear that question all the time. I get that question all the time. I see that question all the time. Is this the right time to invest? And again, YouTubers will have you believe there's going to be a market crash. No, everything's great. There's no doom and gloom, keep investing, blah, 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 right? You have some who just give you FUD, fear, uncertainty, and doubt, right? So I will say that if you're investing in individual stocks, your risk is going to be much greater, right? Much, much greater. And the reason is because if something happens in the economy and that sector or that stock or that company becomes out of or goes out of favor, like real estate has, then it's going to see a substantial price drop, right? Whereas with an ETF that holds a basket of 100, 200, 500 different companies, or even as high as 4,000 different companies, something like, I think VTI from Vanguard, which holds the entire US stock market, unless all those companies go out of business, your ETF is not going to go to zero. It's impossible for it to go to zero. Or maybe there's nuclear war and, there's aliens invade and there's a massive blackout in the world. Maybe then it might go to zero, but still, unless those things happen, your money is not going to go to zero when you're investing into an ETF. It also makes it really easy to implement the strategy dollar cost averaging, DCA. All right. When you're DCAing into an ETF, it's super, super easy. All you do is every time you get paid, you put in a certain amount of money into the ETF, you call it a day. Whereas with investing in individual stocks, you see it all over these groups, YouTube, Facebook, X, all these groups, right? Oh, is this a good time to buy this stock? I think it can go a little lower. I think there's going to be a pullback. It's too what is it? Overvalued. I don't think it's a good buy right now, right? You're timing the market. One quote, and I hate to be that guy that drops a bunch of quotes, but that one quote that reminds me of this scenario is it's about time in the market, not timing the market. Investing into an ETF like an S&P 500 eliminates that risk, eliminates that headache of having to guess in market time. You're literally just putting your money into the ETF and calling it a day. Now, for these other stocks, individual stocks, if you want a dollar cost average, you certainly can. But just know that, as the share price of that stock goes higher and higher and higher, your risk increases along with that, right? There's a risk of a pullback, there's a risk of a correction, or there's a risk of something else happening that's going to cause the share price to go down. Maybe it becomes so richly overvalued that something is going to happen. No idea what, but it could be something as like missed earnings, and investors will pull their money out and it'll just drop the share price. But you bought way at the top, right? You dollar cost averaged at the top. So again, be very careful on how you DCA. All right. One last point I just want to make, guys. Whenever you're investing in either individual stocks or ETFs, you have to put on a lens for the long term, right? You have to build this long-term mindset. You have to play the long game. Okay. If you're going to be investing into an ETF, I mean, it's pretty easy, pretty simple. It's passive. You just put money in it, you set it, you forget, you don't have to worry about it, right? You just play the long game. If a market correction happens and that ETF goes down in value, well, you can just put more money into it, right? It presents a buying opportunity. Whereas with individual stocks, do you know if that stock's price is going to come back up? That's a great question, right? I see it all the time. People buy stocks at high valuations when the share price is high, and then when it drops, they stop buying because they don't know if it's going to recover. It blows my mind that you would buy stock at this price, but not when it hits down below, right? So again, when we're talking about playing the long game, you have to have this lens on that you're going to be holding the stock and buying it for 10 or 5, 10, 15, or 20 years, right? If it's any shorter than that, like if it's a 1 year, you start talking or getting into like swing trading or trading if you're in and out in a day. Not something I really cover, not something I really partake in, because I have the scars to prove that why I don't do it anymore. But you want to play the long game, right? And you want to keep your emotions in check whenever these things happen. With ETFs, a lot of times it presents a buying opportunity, but again, you got to be careful there too, because there's ETFs out there that have never recovered. So again, it's all about your risk strategies, historical context, historical data, what companies they hold. That's why I always say, if you're a new investor, go with the S&P 500, right? You can't go wrong with that. People were buying Cathie Wood's, innovation funds, ARK innovation funds, or all her ARK ETFs. She was the darling of 2020 into like 2021. And then as far as I know today, all of her ETFs are underperforming the broader stock market, which is an S&P 500. Okay. And she's tech heavy. She was this very forward looking person. And now all of her ETFs are pretty much not doing so hot, and they may never recover. Okay. They may never recover despite being tech heavy ETFs. So again, you got to be careful. You got to be patient. You got to play the long game with something like an S&P 500 index, or even something like QQQ, right? Or VGT, right? You have to put on these long-term lenses. Will these ETFs recover? I don't know. I don't have that crystal ball today, but again, based on historical information, I know that the S&P 500 since the early 1900s has returned between 7 and 10%. Very few, if any, ETFs have that claim. They might do well over 1 year, over 2 years, over 5 years, but over 10, 15, 20, and 30 years, not so much, right? The data is not there. So again, just something to be aware of, something to be careful about. So anyways, guys, that'll do it for this video. I hope you guys got some tremendous value from it. Again, please let me know down below in the comment section what you guys think about investing in ETFs. Are you investing in individual stocks? I'd like to hear from you. Why are you choosing ETFs, or why are you choosing individual stocks? Really, it is a great conversation. It's a great conversation for everybody, right? To see different viewpoints, because at the end of the day, everybody is right? There is no right answer when you're investing. There's better strategies. There's methods that are some better than others, right? But there is no right answer, because a lot of people will say investing in the S&P 500 is not sexy. If you invest in individual stocks, you can outperform the market, right? It's not hard to outperform the market. The other camp says, no, you should invest into an S&P 500, set it, forget it, and don't worry about it, right? Both camps are right. The answer is in the middle somewhere, but both camps are absolutely right. There are people who made lots of money, became millionaires investing in individual stocks. Likewise, there's millionaires who invested in ETFs, right? And then there's crazy people who, somewhere out there invested only in the crypto. I'm just kidding. But again, do your due diligence. All right, guys. Let me know down below in the description, or I keep saying description. Let me know down below in the comments what you guys are doing as far as investing. I'd love to hear from you guys. I'll see you guys in the next video.